Three things that professional traders do relating to risk. First up, let's deal with risk reward. This factors into a decision, but is not the whole decision. It's too easy to look at a trade and say, oh, that's got a 10-to-1 risk reward. This must be a good idea. The thing that needs also to be brought into this is understanding of probability. Is this trade actually likely to work based on the information you currently have? This is not back-tested probability. I'll explain how I come to these probabilities on the 3rd of July. So if you want to join me then for an extended webinar looking at how I prep, how I plan a day, how we take trades on, click the link below, come and join. But with regard probabilities, if you take a risk reward of 10-to-1 and think about this like horse racing, if you have a 100-to-1 horse, there is also an implied probability that this horse is not going to win. And it's the same with a trade. Very attractive risk rewards are just that. Attractive, but not necessarily likely to play out. So use risk reward sparingly, but also factor in the probability of the trade working. And I'll explain how to do that in a future session. The next thing is put your stops where you are wrong. Now, what I mean by this is you have to look at a trade and say, right, based on this trade, I want to be in here and I believe I am wrong here. Don't use an arbitrary amount of ticks. I've heard people say, oh, well, I use a 5-tick stop, I use a 10-tick stop, whatever that number is. The reason that doesn't work is because volatility changes, markets change. So where maybe, yes, you would get away with a 5-tick stop, if volatility picks up, those 5-tick stops are going to get hit for fun. So you can't use an arbitrary measure. If you use a point and you say, that's where I am wrong, then you can ask yourself the next question, which is, am I willing to take that risk? If your stop has to be 20 ticks, are you willing to take a 20-tick stop? And alternatively, you can reduce your size down. You can still take the trade with the 20-tick stop, do it on smaller size. That's the way you've got to think about it. And if you still don't like the trade, it's not a trade. If you don't like the risk, if you're not willing to accept it, do not take the trade on. It's not for you. That's what professional traders do. Yeah, they're not taking that trade on if they don't like that risk. And finally, and perhaps the thing that people don't ever appreciate or don't ever think about when it comes down to risk, is you're always told, keep your losses small. Now, where that creates a difficulty is people try and keep their losses very, very small. What I prefer to look at this as is keep your losses small relative to your winners. Now, there's two ways to do that. One, you can maintain very small losses, which also suggests you're not taking on much risk, so it's very hard to get any winners. Alternatively, you take bigger winners, push the upside on trades. That way, your losses relatively are much smaller. This all comes down to the idea of people having targets in P&L terms. So let's say you say, right, if I get to 1,000 up on the day, I'm going to stop. And also if you get 1,000 down, you're going to stop. Now, this doesn't help in the long run. Whereas if you're 1,000 up and you keep pushing and you make that 2,000, 3,000, 4,000, now when you lose 1,000, the impact of that is far less. Simply because rather than trying to make your losses smaller, you've tried to make your gains bigger. And those bigger gains are what make those losses relatively smaller. And that's how you deal with keeping losses small and pushing your winners. That ultimately is probably the key difference between people who do all right and people who do very, very well. It's pushing the advantage when you've got that. I'll explain more on this, where you can potentially push the advantage on certain trades on the 3rd of July. On the 2nd of July, I'll send you my prep where I think those trades are. And then also on the 3rd, we'll go and look at where you had the greatest probability, where you could take the most risk on and how you would manage those trades throughout the day. I'll see you on the 3rd of July.